Hey, you may see it pop up.
Okay, yeah, I'm over here to see. Oh yeah, live on Facebook.
We are?
Yeah, I mean, I see it right here in the corner.
Okay. Good evening, good evening, good evening. You are watching Fatal Distractions. Let's chat. Welcome. I want you to go grab someone. This is going to be a great evening. Welcome to the month of March. I am your host, Gretchen Dixon, and you're in for an amazing month of empowerment. This month, I will have guests on that will teach you different things. So tonight, I'm very starting the month off strong. Is I have Ms. Briana Lacey-King. She is a mortgage loan originator. So welcome, welcome, welcome to the show.
Hi, thank you so much for having me. I'm really excited to chat with you all today about home ownership and credit and down payment and all of the things that come along with that and under that wheelhouse. So I hope we get some good knowledge. And I hope you guys are ready.
Yes, yes. Well, starting us off, we hear a lot about this is a great time for refinancing for first-time home buyers because the interest rate is so low. Yes. So how would someone get started? Say, okay, I'm living in an apartment. I really, I'm tired of paying rent. What are some of the first steps that they need to do?
Yeah. So these are just some things to think about if you are in an apartment right now, and let's say you have a rent that's like $1,600 a month, right? With the interest rates the way they are right now, $1,600 a month can get you easily like a house that's, maybe $250,000 for a home. And in most markets, you could get into a decent sized single family home around that price point. So you think for the same amount of rent, you could be in a home. If your lease is coming up soon, here are some things to consider. If you're moving into a new apartment, you need to have your first month's rent, your last month's rent, and sometimes an additional security deposit. So that right there is well over $4,000, sometimes $5,000. Mm-hmm. There are down payment programs, like there's an FHA loan, you could put 3.5% down. That's around the same amount of money you would come out of the pocket to be in a new home. And when you close on your new home, you could move in right away. So if you close on the 15th, you move in on the 15th, guess what? Your first mortgage payment is not going to be due until another month after that. So if you close on the 15th of April, your first payment isn't going to be in May. It's not going to be until June. So, I mean, you're already coming out of pocket a little bit better. If you're in a position to rent, you're pretty much, you're close to being in a position of being able to buy in most markets. So those are just things, food for thought. Some things you want to do before you kind of hop out on that ledge is definitely going to be checking your credit, getting with a local lender to see what your buying power is, and then getting with a realtor. Once you've done all three of those things, you could certainly be into a home, usually within about 30 days, depending on the market and how quickly you could decide on a house, of course. So I'd love to expand a little bit more about those points. Unless you have any questions about those you'd like me to kind of go over, Gretchen, or kind of dive right in.
Yeah, just dive right in. And I'll ask questions if I come up with something after that.
Perfect. Yeah, so the first part of that is going to be looking at your credit. You always want to check your own credit just to make sure there's not discrepancies in on your file. If there are discrepancies, things that you've paid, you've paid, you have proof that you paid it, or you have proof that insurance was supposed to pay it for like those medical bills. You want to go ahead and get those like really quick and easy disputes out of the way on your own for free before you come to us, because your score is going to be much better. And then your buying power is going to be much larger. You're gonna have much more wiggle room in what you could buy if your score is higher. So that's something you could do for free, like I was saying. And there is a common misconception, hopefully it's not as common anymore, that checking your score will lower your rate, or your checking your report will lower your score. That's not the case. Anytime you check your credit report, that is a soft inquiry when you check your own report. So you could do that for free on like Credit Karma. You could do it for free. You could set up an Experian account, TransUnion account, whatever the case is. Personally, I have like a Credit Karma account that I've used if I had to dispute anything. I had a bill one time. It was like a $7,000 medical bill that was paid, and I didn't know it was on there until it was on there for like a year. And then
Wow.
when I was going to look for my house, I was like, why is my score so low? Like, I don't have any debts. Like, that's weird. So I looked, and lo and behold, all the way at the bottom of my report, there was this bill that had been paid for years. So those are things that just, my own experience, just make sure you're looking at your stuff to make sure you're accurate. Once you're done with that, you've taken a look at everything is, true, come to your lender. We will, myself, I am a lender, so we'll take a look at your credit profile and we will pull your credit. This is another thing that people are concerned about, having too many inquiries on your credit. Now, multiple inquiries on your credit can lower your score by a few points, usually like 5 points or so. And that's for multiple inquiries. What that means is if you went to 5 different department stores and you applied for 5 different credit cards, that's 5 inquiries right there. That could seriously ding your report, because you're potentially opening up 5 lines of credit. But when you're shopping for a mortgage and you're talking to multiple lenders, which you should, the assumption is that you're only going to come out with one mortgage and you're just shopping for, rates. This is one of the biggest purchases you're going to make in your life. You should be shopping around for it. Just like you're shopping for the house, you need to shop for the mortgage, because one lender might, have something that's going to save you $3,000. One lender might, for the same price in points or in closing costs, be able to get you into a lower interest rate, which is going to save you thousands of dollars over the life of your loan. The credit bureaus understand this and they know this. So you have 30 days to shop for rates, and it's all going to count as just one inquiry.
Well, that's good to know.
So those are just some things you should think about. So make sure you're talking to your lenders and just kind of keep an eye on that time, on that watch you started, 30 days. So make sure you kind of have your decision by then. Once we kind of look under the hood at your report, at your profile, we're going to look at a few different things. So we'll look at, of course, your credit score. But we're also going to ask you about your down payment and how much you have saved. We're going to ask you about what sort of monthly payment you're comfortable making as far as housing expense. Because you are actually approved for, let's say, a $300,000 loan, if you're not comfortable making a $2,000 mortgage payment a month, I'm not going to recommend you go into that loan. I want to find out what your current housing expense is. I want to find out what your other monthly expenses are, and see if you're actually comfortable making that number. And, that's something you and whoever else you're purchasing with, if there is another person you're purchasing with, should really kind of have an ideal in mind. And then from there, we'll kind of assess all of these things and plug you into a loan program that makes the most sense. There are multiple different programs. I will go into kind of an overview on the most popular ones. I would say the most popular loan for first-time home buyers specifically is going to be an FHA loan. They are ideal for people that have good credit, but they just need more flexibility. And it just offers a lot more for you. So the down payment is 3.5% of your loan amount. So it gives you a little bit more money in your pocket for that new furniture or whatever else it is you're going to buy once you get into your house. They do have a minimum credit score of 580. This is going to be the lowest of the minimum credit scores because this is government backed. So you do have wiggle room with your credit score, 580. And then they do have maximum debt to income ratio of 57%. Someone might ask what your debt to income ratio is. This is what I was saying earlier when I was saying, okay, well, you make this much, but you have a car payment, you have credit cards, you have all of these things. Your debt to income ratio is just that. So how much debt, including your housing expense, do you have divided by how much you make monthly? So we have up to 57%. So just keep in mind, if you're shopping for your mortgage, but you have a high credit card balance, you might want to pay some of those down. If you have a car note and you have a car note that's $500 a month, but you only make $2,000 a month, that's already 25% of your debt to income. We only have 22% left for your house. So that's just something keep in mind. But we could go up to 57% here, and this is the most wiggle room you're going to get. So if you are in that higher debt to income ratio, we'll probably recommend an FHA loan for you.
Okay, question.
Yes.
What if, okay, in the scenario is that I understand, 57%. If I have a high credit card, I've heard that on your, besides the debt to income ratio, that if I have a certain amount, like if I have a $10,000 credit card and I owe $9,000 on it, that's frowned upon because revolving credit should be below a certain point.
Yes.
So what is that marker for like revolving credit, like credit cards and so forth that it should be?
Yes, of course. Thank you so much for asking that. So this is actually twofold, right? So the marker for where your revolving credit should be at is, they say it's 30% or less, but really, if you want the most bang for your buck, you're gonna want to be at 9% utilization or less. So if you have a $10,000 credit card limit, you really want to have about $900 on that card on your statement balance or less. I mean, can you go to $3,000? Sure. But really $1,000 and below is going to get you what you want. And this is what I mean by that. At 30% utilization rate, you will not harm your scores, meaning your credit score. At 10% or less utilization rate, you will actually get your scores to increase exponentially. So that is going to help you on the interest rate you're going to get in your house, which will then help you with how much house you could afford, right? Because the lower your interest rate, the lower your monthly payment would be, of course. Now, the other reason why you want to be careful on your utilization is this debt to income ratio we were talking about. So if you could spend on, let's say, total debts, you could afford $2,000 a month. If your credit card statement comes out and your statement says that your minimum payment is $1,000 that month, that's the debt we have to count. It's whatever your statement says is your minimum payment. And we do know that fluctuates, but that's the debt we have to count. So you want to make sure that you are paying as much. If you can't pay your credit card off in full or almost in full, you want to make sure that on your statement date, whenever it's going to read, it is reading at a pretty low number. So that's not always the same day as your bill date. So for example, my credit card is due on the 3rd of March. The billing statement, I believe, is like the 6th or something. So if I pay it on the 3rd, if I didn't, let's say I had a $600 balance, I paid $300 of that off. On the 6th, the credit bureau is going to report that I have a $300 balance. So you just want to make sure, check what your statement date is and make sure that something is paid before that date. As much as you can, if you are in a position where you need more wiggle room in your debt to income ratio.
Okay, another question. I also heard, because we built a house about 7 years ago. And one of the things that they were at the time telling us, and I don't know if that's still true, is that even if I have 5 different revolving accounts and they're all at a zero balance, when it comes to counting in my debt to income ratio, even though those are at a zero balance, somewhere they were trying to tell me that they still calculate that into the numbers. Is that true?
That is not true. So it's really, it's true and false. So if it's at a zero balance at the time, like if you're looking at it, you're like, I don't know what you're talking about. My balance is zero. But if your last reported statement said that you had, a $2,000 balance, that's what they're going off of. even if it's zero now, we've got to wait for that next statement to come around and say that it's zero. Once it says that it's zero, that's what we're using, and you don't have any debt to count to it. But you need it to report, because the day that it's kind of a little bit of a game trying to figure out what day it's going to report to the credit bureau and making sure your balance on that day is favorable to you.
Okay. Okay. That's good.
Everyone's will be different. But you could look at your first of all, look at your statement, but then also if you just are kind of like, if you have like Credit Karma, for example, you could refresh that every day and see if it's updated, because some bureaus, some cards kind of lag a few days. So just make sure you know what day it reports to the bureau.
Oh, okay. Okay. Now into the home buying process, say I'm living in an apartment and I want a house, but I don't know the first thing about purchasing a home, any of the requirements. Are there classes or something available that before I step into home ownership, the things that are involved in home ownership, because it's different than living in an apartment?
Yes, it is. It's much different. Yes, so there's going to be home ownership classes. There are actually some through, so we're in Texas. I know not everyone is in Texas. Let me find the website for it. One moment. There's like a Texas state. 1 second. Down payment assistance. Like anywhere that has like a down payment assistance program will have free and actually mandatory home buyers classes. So if you're in Texas, this is the one that I know that you're going to want to write this down. It's the Texas State Affordable Housing Corporation. And that's TSAHC.org. And they can kind of link you to what you need to know. There's something that says home buyers and renters here. And they could kind of walk you through some classes that'll talk you through the process. Another avenue, if you don't have that, is really just reaching out to your local realtors. They partner with lenders. So like I'm on a first time home buyers class the first Monday of every month with a realtor that I partner with. And they're out there online, and because we want to make sure you have that knowledge, and we want to get you excited about the process, so that way you're reaching out to us and that you're buying a home with us. So most lenders, most realtors are offering those courses, and they are complimentary for borrowers to get you the information that you need.
Oh, good. Okay, what other type of, well, is there a cap on the amount that FHA finance?
Yes, and they are county limits. It's a little bit under 400 in our area, and there are some higher income areas that are a little bit more. But I believe it's a little under 400,000. And let me take a look here. I could do the calculation for you. I believe it's 386,000 is the minimum for an FHA loan.
So 386,000 for FHA, and then you just have a 3% down payment.
3.5% down payment.
Okay.
Is your down payment. So.
Okay. What other type of loans are out there?
Yes. So other loan types that you should probably consider as well. I would say the second most popular that we see, of course, is going to be your VA loan. So if you have served in the U.S. Armed Forces of some sort, military, Coast Guard, reserves, it doesn't really matter. As long as you have, an eligible standing with them, you have what's called a certificate of eligibility, you are able to get what's called a VA loan. The VA does not lend these. You still want to go to a lender, but the VA does like back your loan and insure your loan. So with that, because it's a VA insured or backed loan, you are actually eligible for 0 down payment. So if you are a renter and you are also a veteran, I highly recommend getting yourself into a home this year while the rates are still low. The income, they are really strict about your job history. They want you to have a solid 2 years of job history, and that could include being in active duty, but you need to have a solid 2 years with no employment gaps. But other than that, they're pretty lax with the credit score. again, you'll probably 580. You can get down a little bit lower in some circumstances, but 580 is usually what you want to be at at a minimum. And they are going to be a little bit more lax with your debt to income ratio as well. So I've seen it all the way up to like 60% on some people. Because
Wow.
you want to get veterans into homes. The only really downside I could think of is that the inspection process is a little bit more rigorous for the homes, because the VA does want to make sure you're getting into, a good home that is not going to end up being a money pit for the veteran. And they want it to be a solid investment for their vets. So there are some sellers that are a little gun shy on accepting VA loans, but I think like the Patriot and almost all of us wins out eventually, and you should be okay.
Oh, that's good. That's
Yeah,
good.
that's just something to keep in mind. The good thing about that is there's no mortgage insurance on a VA loan. We didn't get to touch on this, but there is an additional cost for an FHA loan or any loan that you're putting less than 20% down on. It's called mortgage insurance. Basically, the idea is if you're putting less than 20% down, you're at more of a higher rate to walk away from the home because you had less skin in the game. You put less money into it.
Yes.
So you are paying into a government backed insurance program, basically, that if you walk away from the home, they'll cover your default to the bank. So you have to pay into that. Everyone has to pay into that regardless of their credit profile. And that's your mortgage insurance. VA loans do not have mortgage insurance. So that's extra money in your pocket, but they still have rates that are favorable and low, just like an FHA government loan. So those are just some things to consider if you have that option. I always recommend the VA loan for anyone that is eligible for it. I have not seen a circumstance where any other loan was more favorable for them.
Wow, that's good. And what if you say, okay, I need a house that's more than 300,000 or 400,000. I have the money, I have the income. I've been living, I've been traveling, haven't really been situated long enough to find a place. I've been living in apartments because I've been in my job, been traveling, but now I can afford. I'm at an income level where I may want that $600,000 or $700,000 house in our area. That's a lot of house for
Yes.
So what exactly do I do? Where would I go, since you just said I'm not a veteran and over the limit for FHA? So then what do I do?
Of course. So there's kind of two answers to this. The regular answer to this would be to go conventional. If you're just, you're a higher income earner, and you want a home, and so you have an option if you are under about 550,000. To be exact, the loan limit for conventional loans is 5,480,000, 548,000, 100,000. 250 bucks. I can't say that number. I'm sorry. But yeah, 548,250. And that's for a conventional loan. You could still put 3%, or really actually 5% down on that. And you'll have mortgage insurance and whatnot. You'll have your credit limit is going to be a little bit, or your credit minimum is going to be a little bit higher. You're going to want to have at least a 620, but really you're going to want to have at least like a 740 for that sort of figure. So that way your interest rate is more favorable. So anywhere between those two would be good. And then you're just going to want to have, the 5% of that amount is going to be a little bit bigger of a down payment. But, if you're someone that's been traveling, you should be fine. You should have something. If you're traveling for work, you don't really have a housing expense. You probably have plenty of money saved up to do that sort of thing. So there are conventional products that you could still put 5% down on and be okay. If you're trying to go, like you were saying, a $600,000 or $700,000 home, there are still options for you. You could do a jumbo loan. A jumbo loan is what's considered a manual underwrite, which means you really have to have the best credit profile. You need to be really at a 720. You need to not have anything in collections. You need to not have anything questionable on your credit profile, and you need to have 20% down. It's just kind of as long as it's kind of a no-brainer, you could qualify for what is considered a jumbo loan. And then the third option for that would be to do a first and second lien on your home. So you would do your first lien all the way up to the loan max. And then you would do your second lien for whatever the balance is. And then you're probably going to want to put the 20% down on those. You're going to need to for the first lien, and then for the second lien, you're going to want to put a similar amount down. Probably you could do a little bit less, but I would do 20% just to get you in a more favorable pricing for your interest rate. Because again, when you're at such a high loan amount, you want to make sure you're at the lowest interest rate as possible, because it's really going to make a difference in your monthly payment.
Wow, this is good. What about builder incentives? You were saying, okay, going back to FHA, because that's probably a lot of people fall within those guidelines. The home ownership, besides the 3.5% down, what about builder incentives? Like when we built our house, there was a builder head incentive, I think $10,000 or $20,000 that they were going to give us.
Yeah.
So could that money, that a builder incentive, go towards my closing or my down payment, or are there restrictions on?
There are restrictions. Yes, it could go towards your closing costs. This is, as with most things in mortgages, most things are very multifaceted, right? There's a lot of different answers for the same question for a lot of different reasons. Yes. But for example, for an FHA loan, there is a minimum contribution. And at minimum, you need to have the 3.5% down payment. That has to come from the buyer.
Okay.
There are incentives. Up to 6% of the total loan amount can be given in incentives. So like towards closing costs or whatever the case is, that could be given. Or if you want to like buy down your rate and have a lower, there's something you can pay called discount points, which is usually a percentage of your loan amount. Usually like, let's say 2% or so, to get your rate lower than what you were initially quoted, which is going to save you money over time. So if the builder's giving incentives like that, you could use it to get a lower interest rate and save money. There is a new exciting rule that has been passed for multiple reasons. So there is a guideline called the Respa Act. The Respa Act requires anyone in the mortgage industry, basically, and that's like settling your loan, they can't require you to use any other business. They can't require you, like a realtor can't require you to use their lender. And for the longest time, builders can't legally require you to use their lender. That violates the Respa Act. But for the longest time, they were skirting it by giving you incentives.
Yes.
Because they owned the lender. However, because most people do not understand their loan documents, they actually weren't saving much money by using this lender, or any money at all. So sometimes when people put my quote, I'm just with a regular brokerage firm, especially for an FHA loan, against the builder's quote, even with the incentives, my quote is actually less money for them. But because there's this big, red line and a sticker on it that says $4,000 off, it looks like the builder's quote is better. So now legally, they just kind of did this. I think it was effective January 18th or something. If a builder is required or is offering you incentives to use their lender, they have to offer that same incentive no matter what lender you use. The incentive has to be tied to the service they are providing, which is the house. They can't do that anymore. So if you have that, if anyone's running into that, you can look it up, just like Respa Act update January 2021, and it should pop up for you. So that's just something to keep in mind, that number one, the incentives have to go towards whoever is doing the loan. And number two, just double check that even with the incentives, go with whoever is going to save you the most money.
That's good. That's
Those are
good.
just things. Those are just things to keep in mind now, because they have been kind of flying under the radar with that
Mhm.
for years now, and it just kind of got squashed recently.
That's good. Now back to credit, because that's a big thing nowadays, especially with people that with COVID and everything that happened.
Mhm.
Since I used to be a realtor long time, 100 years ago. And I tell everyone when I was in Arkansas, and we built a few homes, so I know a little bit because between those two. But one thing I get asked often is about the credit piece. When you're starting, okay, I want to go back to I'm ready to build or I'm ready to buy. I need to pull my credit. There's some things on there. So how long from that time to get into is there a time frame that get things off your credit? Because people are like, how long is this going to take? Or just some general idea about with the credit issue that I see.
Yeah, I mean, it really depends on the issue, on what the problem is, right? So I mean, if there are things that you need to dispute, I would say like 90 days to get it all over with, because we can't have the things still actively in dispute
Mhm.
when we're doing your loan. Um, yeah, I would say give yourself like 90 days before that. But once you've kind of done that part, in total, I've seen people that need credit repair for like just a quick 3 months, 2 months, 2 to 3 months. I've seen people that need like more extensive like 6 months of credit repair because they need to go get the secured card and then they need to make payments, for a few months on it, or make purchases and then make payments, or have their utilization kind of revolving for a few months, or they need to let a late payment fall off. Those are all things that they need to kind of calculate in their time frame. But I would just kind of keep it in mind, about 3 months if you have some things you need to work on, as an average.
Oh, that's good. Now what's the point of getting a secure credit card?
So the secured credit card is just easier to get than a regular credit card if your credit is challenged. So a secured card means you actually paid. So you can get it usually like from your bank. You can get one from Capital One, I think, too. But usually, like if you bank with someone, you're in good standing with your bank. It's usually quick and easy to say, "Hey, I want to get a secured card." What that is you pay them up front for it.
Mhm.
So you pay them. I would try if you have the means to do it. I would try and do like $1,000 one. So that way you have a little bit more leeway. That way you have, 90 dollars that you could spend and be within that utilization that we want.
Mhm.
Um, you pay them $1,000. They hold on to your $1,000. Um, and then they issue a credit card worth with a limit of $1,000. Why it's like that is, if you happen to charge your card up $1,000 and you don't pay it because your credit profile says that you're likely to not pay this,
Mhm.
they have your money already. It's like
Yes.
you've prepaid your credit card. So that way, if something were to happen and you were to default, which you're not going to because you're about to want to look for a home, so you're not going to
Mhm.
default on anything. But if you were, they already have your money, which is why they're more likely to issue this to you. But what you want to do, you give them the money, they give you the card. You want to use it. It doesn't help you if you don't use it at all. They have to see that you're using it and that you're paying it. But I would charge no more than, again, like I said, like that 9% to like the $90, as your monthly statement, and then pay it off. $90, pay it off. That's really what I would do for a few months, and then you're avoiding interest by paying most of it off. Maybe like leave a $5 balance on there or something so they could see that it's being used. But other than that, I would just go about it that way for a few months, and you're going to see your credit score rise exponentially, because credit or credit utilization, it's I think like 35% of your score. So it's a big chunk of your score is how you are utilizing those cards. So I would just keep that in mind and use that. So same example, if you only have if you have the means to do like a $500 secured card, you want to keep it to about 45 bucks or more. So it's a little bit less wiggle room for you, but it's doable. Again, if you go up to 30%, it's not really going to harm your score, but it's not going to hurt it, or it's not going to like help it either. So I would really try and stay at that 10 to 9% utilization.
Oh, that's good. So the purpose of the credit card basically is to help boost your credit.
Yes.
Well, good. This has been some good information. So anything else that you wanted to share that I haven't asked?
Yeah, I would just want to touch on student loans, I think.
Oh, yeah.
For you guys, a little bit of a curveball here. Student loans are something you always want to keep in mind. Not really always want to keep in mind, but it's just something that you want to keep in mind when you're talking to lenders, especially if you're a borrower that has high student loan debt, you're highly educated. There are so many options for your student loans and how we have to count them against your debt to income ratio. If you meet with a lender and they automatically tell you like, no, you can't qualify, your loans are too high, ask them how they're qualifying you. So a lot of times, if your loan, let's say you owe $200,000 in student loan debt, which I know people that do. Most people with like master's degrees or multiple degrees have that much student loan debt. Can like kind of the easiest way for mortgage lenders to calculate that your repayment is to take a 1% payment factor, which is $2,000 a month. Which no one is actually paying $2,000 a month on their student loan debt. No one's paying that, right? But that's the repayment factor that they are taking. There are other avenues to get that lower. You can change your loan program. So FHA does require that if your loans are not like in current repayment, if it says that you're like, if you're deferred for whatever reason, it requires that we assume a 1%, but we might not have to go FHA. You could go conventional, which if you go like Freddie Mac, you could do a 0.5%, which saves you $1,000 on your debt to income ratio right there. You can also get a letter from your lender telling us what the amortized payment would be or is over like a 30-year time. You have to contact them and ask them for that letter. But if you could produce that letter saying this is what the amortized payment is, that's what we'll use. And that's much lower than 2 or 1% of your loan amount.
Oh, that's good.
So that's just something to keep in mind. If you do have a higher loan amount, you might want to go ahead and like contact your provider and get an amortization letter, and then provide that along with your loan. And that's just something I like to make sure people have that information.
Oh, that's good. Yeah, I forgot all about student loans. They are a factor. That's a huge factor sometimes.
Yeah, they are a factor in that debt to income ratio. So that's just something to have in the back of your head if you do have, I would say if you have like over $100,000 in student loan debt, you'll probably want to consider that. Or if your debt to income ratio is tight for other reasons, that might give you a little bit more breathing room than when they initially pull your credit and they initially just plug in that 1%. Depending on who your lender is, they might not ask you those sort of questions. They might just plug it in automatically and just approve you from there. And then you're wondering like why I didn't get approved for more. It's probably because your student loans are eating into your debt to income ratio, and you need to ask some questions about how you can get that factored a little bit differently.
Wow. So how much money do they need to have in savings? You said you had to have a savings. So how much do I need to have? You know, I'm trying to buy a house and my score is barely 620. I'm young. So how much I haven't had time to save money. So how much is it?
Yeah, I completely understand. So there's a few ways you could go about getting money too. So, but all in all, you need to have your down payment saved. So I would say no less than 3.5% for that down payment. But there are other factors in getting your loan. There's closing costs. Closing costs could be another 2% of your loan. So really, you probably want to have 5%, maybe 7% actually in some markets, of the housing expense you're expecting, saved or in your accounts or available to you in some other form. And I'm going to get to that in just a moment, the other ways you could get that money out. So those are just things that you could, those are things to keep in mind. So right now it is a seller's market. It is not a buyer's market. It is a seller's market. And a lot of offers are, a lot of winning offers are actually saying that we will pay closing costs. Which if you're a first time home buyer, closing costs are like just all of the different costs associated with getting the loan done. There's like titling. So basically the company that actually like deeds the home over to you, that's what makes you the owner of the home. That costs sometimes like 1% of the loan amount, right? Then there's like taxes and insurances and things like that like the borrower always needs to get. But yeah, people are offering to pay all of the closing costs right now. So if you are in a seller's market, you should probably have that in mind. So that's why I say probably closer to 7% of the total house cost is how much you should be thinking about bringing to the table, just to make your offer a little bit more competitive. As far as where you're getting that money from, there are multiple sources. One, of course, is just from your own savings, over time, your hard-earned savings. Another source that's available and that you could utilize if possible is going to be a down payment assistance program. Again, this is through like if you're in Texas, and actually there's like a lot of like local municipalities that might have it. So I would check with your city first, whatever city you're in, check with your city of Bastrop down payment assistance program, and just see, or with your county. If you are in an area where the housing market is a little bit slower, you're more than likely able to find down payment assistance programs. In the state of Texas, for example, this is the Texas State Affordable Housing Corporation. That's what I was telling you about the classes. They have different down payment assistance programs. So I would go to that website, Texas State Affordable Housing Corporation. Go to that website for down payment assistance. So those are options for you as well. Another option is gift funds. You are allowed to receive gifts from a family member or someone like in a close circle, as long as it is a gift, as long as it is not someone that stands to benefit from the purchase of your home. So it can't be from the seller, it can't be from your real estate agent, it can't be from your lender, can't be from the title company. It could be like an employer rather, could give you a gift or a down payment assistance. Sometimes like employers will do that if you're moving or relocating. Those are things, anytime you have a gift, as long as you get a letter, you're going to need a letter from the gifter saying that this is truly a gift. And then they will have to be able to show that they have the means to gift this to you. So they'll have to show their bank account statements or wherever their source of where it's coming from. Another source, let's say, you're a young professional and you have a 401k, you can take a loan out against your 401k. Actually, that's available to you for the purchase of a home. You want to talk to your 401k provider because the specific rules are going to be a little bit different for each one. But for the most part, you could take either 50% of the total vested balance or $50,000, whichever is less. Usually, right now there is for COVID. I don't know how long this is going to last. Right now, you could take up to $100,000 out just for COVID relief in general, and then you'll want to pay that back. Most plans, you need to pay it back within 5 years. And you would just set that up through additional contributions with your HR department. So that's another option you could do for your 401k to get that down payment.
That's good. This has been very good. Those are just tuning in. You've been watching. You're watching Fatal Distractions. Let's chat. And I'm your host, Gretel Dixon. I have with me Briana Lacey-King tonight, who is a mortgage loan originator that's giving some powerful insights and tools if you're looking to buy a home. You've been thinking about it and talking about it, but you don't know where to start. She's sharing some great nuggets. For those of you that are watching live, make sure you share. Also, those that watch it in the replay, it's a blessing. It's a blessing. Anything else, Briana, before we get ready to close for tonight?
No, I think we covered a vast majority of subjects when it comes to the process. I am available if anyone has any specific questions, but I think this covers most of the items I wanted to touch on. Did you have any other questions for me?
If someone wanted to reach out to you, how can they find you or reach out to you to either to secure a loan or to help direct them?
Yeah, of course. So I have a few different ways to contact me. I think the easiest way to find me is if you have a Facebook. You're going to want to find me on Facebook, and it's just Briana Lacey-King. My name is Lacey-King, and I have it's going to be like an actual page for mortgage. So it's at Lacey-King Lender, which is actually my handle on Facebook and Instagram. So it's usually the easiest way to find me. I could give you guys my email. It's a little bit long, but you can email me as well, or you could call me. So I have a cell phone. I don't know if anyone is ready to write this down, but my work phone, my work cell phone, it's 512-491-1059. So that's actually really like a really quick way to get a hold of me. I always have my phone on me, and I'm always ready to kind of pull up your file and answer some questions. It's a completely free consultation. So even if you just have just a few questions and want to know, the good thing about us is once we run your credit profile once I look at it once and you're in our system, we can look at it again 6 months later, and it's not counting as another inquiry. It's actually a soft inquiry. So I could pull it as many times as we need and go over this as many times as we need with you guys. So those are really the easiest ways to find me. And then the third way, for those of you that would like to email me, is my email, which is B for Briana, and then my last name, Lacey-King, and then at my company name. So my company name is Ask Mortgage Pros, which is like ask a question, mortgagepros.com. So that's gonna be the third way to reach me if you would like.
Well, great. This has been so, thank you again, Briana. This has been so informative. In case I decide to buy a $1 million house now, I know what I'll have to do.
Yeah.
Moving forward. Yes, if I don't pay cash for it, then I know what I have to do. So thank you again for being on tonight. Those of you that are watching, make sure you share this. It's powerful information. Reach out to her if you have any questions. And don't forget to tune in again next week for Fatal Distractions. Let's chat. So thank you again, Briana, and those of you that have been watching. Have a great week. Good night.
Thanks. Good night.